Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Hello and welcome back. For those of you who are just joining us, I'm Manisha Tank. Thank you for joining us for the final session of Emerging Markets 2022 Investment Strategies for a Brave New World. The time has really flown by. It is brought to you by Bloomberg Media Brand Experiences, and it's proudly sponsored by Standard Chartered. Once again, I'd like to encourage everyone tuning in from around the world to join us in submitting your live questions. I'm going to try and weave them into the discussion wherever I can. So do get onto the Q&A button and make sure that you submit. I'll make sure that it's a part of the conversation. Coming up, we have a panel which is going to take a deep dive into Africa. There's a wide range of views and opinions on Africa that can be pretty confusing to decipher. So we've got some experts in this session who are going to look at how investors can view the continent and then take those current issues and look at what we're struggling with, what we're grappling with, but where the big opportunities are. In terms of what we're grappling with, the global pandemic, of course, and the progress of vaccination rollout, those are very much two big topics of concern. But there's also on the economic front, inflation, stagflation, and where that affects the opportunities and the risks as we look forward. So giving us a lay of the land, we have Razia Khan, who's Managing Director and Chief Economist at Standard Chartered for Africa and Middle East Global Research. We have Brett Rowley, Managing Director, TCW Emerging Markets. And Brett will help us understand why there's always opportunity in African markets. He'll also give us his take on how investors approach that. We'll have Nicholas Sangner, who's Portfolio Manager at Faro Management, who'll give us his take on institutional strength in Africa and also which of those frontier markets you might want to have your eye on. And also Sher Naqshbandi, who is Head of Macro Trading for AME Markets at Standard Chartered. He's going to share a trader's perspective on opportunities in Africa, and he's also going to go by the name of Shaz for the rest of this conversation. Okay, we'll start with Razia. And Razia, we're going to take a very broad approach with you just to begin with. How should we understand this investment opportunity in Africa right now? And what would you say are some of the common misconceptions out there?
So let's start with the very first one, Manisha, and this is about growth. You started off with the opener. We know that the pace of vaccine rollout has been a big determinant of growth, and while it is the case that in much of Africa, sub-Saharan Africa especially, we are seeing a disappointing pace of vaccine rollout. We know that there have been great supply bottlenecks. It would be entirely misplaced to think that growth is somehow not going to be coming back to the region. What we see is something of a staggered recovery, but it's certainly true that compared to the synchronized lockdowns that had a great impact on economic activity across the world in 2020, in 2021 that has largely been absent. What we've also seen in individual African economies is something of a growth bounce back, often driven by the recovery in other trading partners, other developed and emerging economies, but that has created greater demand for commodities, and some of those commodity producers will be doing better. It is also the case that while the threat of COVID unfortunately persists, we have seen with successive waves of COVID less impactful government regulations, less impactful lockdowns, milder containment measures, and this has allowed for some demand to reassert itself. So the investment opportunity in Africa, when most investors look at the region, this is a region where they expect to see eventually the restoration of more robust rates of growth, the demographics, the long-term drivers of that, the urbanization, the productivity gains, adoption of new technology will still be a key part of that. But there's also an expectation on the part of investors that especially when it comes to frontier markets, they're relatively small. You would expect to see far higher yields to compensate you for risks, including liquidity risk, and that remains the case across much of sub-Saharan Africa.
Razia, a bit of a follow-on then. What is it that Standard Chartered sees in this region that maybe others don't? I don't know if that perhaps overlaps with some of what you were just saying, but I think there's more that we can draw out of this.
Certainly, if we look to demographics and what that alone tells us about where growth is going to be coming from in the future, we all know that Africa is the youngest region globally. We all know that there have been these episodes of faster, more accelerated growth in the past, sometimes tying in with favorable commodity price cycles, but that hasn't always been the case. There has also been something of a structural shift underway as we see an improvement in the reform environment, the adoption of more conducive economic policies that are conducive to accelerated growth, to lifting prospects, a rising middle class, and it's important to emphasize that just because we've been tested by the COVID crisis, the conversation had been dominated by talk of how everyone is left with a higher public debt burden and the growth profile, the growth outlook looks a little bit weaker going forward. We should not forget these fundamental positives. If we're looking at the fundamental drivers of growth, the demographic profile of sub-Saharan Africa, the fact that this is still a region where we expect to see rapid urbanization, greater productivity gains, means that it's too important to be ignored as a source of future growth.
I love it, Razia. You've given me such a great tee-up to a question that I then wanted to put to Brett about this. So Brett, obviously, Africa, not a homogeneous part of the world. It's so varied. Razia was talking about some of the demographics there and how that's just a fundamental indicator of where we could be in the future. What would you say are some of the biggest opportunities on the table?
Thank you, Manisha. I guess one of the, as Razia mentioned, one of the big macro themes that has been driving African asset prices this year has been this rising commodity cycle. Many countries in Africa we know are net commodity exporters, but they're not all commodity exporters. And even those who do export commodities, there's a fairly diverse production profile. We obviously have Nigeria, Angola, Gabon who export oil. Mozambique, Tanzania, Senegal developing gas. Other countries such as Kenya, Ethiopia, Cote d'Ivoire, big agriculture producers with tea, coffee, cocoa, cashews. We know South Africa has mining and metals with gold, platinum, iron ore, and then Ghana has the trifecta where it does have oil, cocoa, and gold. But my point is you can't just paint Africa with a broad commodity brush and expect to outperform. Some countries will benefit from higher oil prices. Others that are net oil importers or fuel importers, will be hurt by them. And so we need to be a little careful about how we invest across the region, and there's increasing differentiation amongst investors as we look at Africa.
Absolutely. And that is the question, isn't it? How do you navigate that space, which is just so varied? We'll circle back to that a little bit later and see, where you find those inflection points. I know that's something we're going to talk about up ahead. But before we do, I want to bring it to Nick. Nick, tell us a little bit more about your viewpoint on Africa and the angle at which you're coming from this you're coming to this conversation.
Thank you so much. One thing I like to say is that the growth of African market has been extremely impressive over the past 10 years. Here at Faro, we started an Africa fund in 2013. And our investment philosophy and approach has always been to try to look at Africa as a set of idiosyncratic stories and try to take advantage of those stories. And what I can say is over the years, these opportunities have only increased. And when it comes to investing in frontier markets, one of the biggest misconception is that in order to capture the high growth that Razia was talking about, one should be investing in public or private equity. In reality, in most of the countries we cover, fixed income investment, whether it is local currency bonds or euro bonds, have actually had better returns over the past 10 years than the public or private equity indices. The truth is that currency devaluation in all these countries tend to eat a significant portion of the return that you might get in the equity investment. And the main reason for that is that African countries tend to run a very high real rates in general, and this is in contrast with what is currently happening in the developed world. This makes local currency bonds in Africa a very, very difficult asset class to compete against. And this is precisely the reason why at Faro we tend to spend a lot of time looking at local currency assets. And in places such as Nigeria, Uganda, Ghana, or even Egypt, they've been over the past 10 years, lots of opportunities, lots of very interesting stories that people could take advantage of. And people don't realize that in a place like Ghana, in the numbers that I look at, let's say from 2014 to 2019, despite the devaluation of the currency, the best asset to be in was actually local currency. And local currency bond in particular. And the second thing I'd like to mention, because I get that from our investors all the time, is liquidity. People are always very concerned about liquidity when it comes to investing in Africa. I would say two things. First, liquidity management is an integral part of the investment process. And that should be assessed on a dynamic basis rather than statically. At any point of time, one needs to know exactly what type of liquidity profile you have. And the second thing is that the problem that one might have in repatriation of currency is not specific to African markets. You all remember that when Turkey had a crisis in March 2021, it was extremely difficult to get the dollars back. So in conclusion, what I would say is African economies are structurally improving, the financial markets are expanding, and the growth prospects are better than anywhere else on the planet right now.
Thank you so much for that, Nick. And with that, actually, can I bounce it back to Brett? Because, Brett, I know we've talked about this. If you hear about those sorts of opportunities, some of the stuff there that Nick was underlining, how do you get involved? Let's talk about the bond market, for example.
Sure. And here at TCW, our emerging markets team, we invest across the entire spectrum of emerging markets debt. So the dollar, or hard currency euro bonds. We have the local currency government bonds, and then also, we have a team that looks at corporate credit, both dollar and local currency as well. And I completely agree with Nick. I started covering Africa a little over 10 years ago. And the investment opportunities in the space have grown substantially over that period. I remember when I started covering it, I think it was less than 4% in the MB, and there were just a handful of issuers. South Africa and I think Ghana and Gabon each had one issue out at the time. Since then, we've had 20 some odd issuers in the Eurobond space, and several of them have multiple issues and so there's actually a real Eurobond curve across the space. So it's for those who don't want to take currency risk, then the Eurobonds are a good opportunity to go ahead and get exposure to sub-Saharan Africa. We also, as Nick mentioned, we also look at the local currency opportunities. South Africa is currently the only African country in the widely used JP Morgan GBI EM index. But we also look at off-index opportunities, and so other opportunities there, such as Nigeria, Egypt, Ghana, Zambia, Kenya. Those are ones that we've been involved off and on in the past. Egypt has been one of our core off-index holdings for since I think early 2017, right after they did their big devaluation. And then JP Morgan just recently announced that Egypt was going to be included in that GBI EM series. So we do think it's a growing opportunity set, and so most of our exposure tends to be through the euro bonds and the local currency. But I would agree with Nick. These bond markets offer a great opportunity, and tend to have decent liquidity when you want to get in. The local currency markets can be a little more tricky to try and get in and get out of, but it's not impossible to do that.
Thanks very much for that, Brett. So I want to take it to Shaz now, because Shaz, we've heard from Razia, we've heard from Brett and Nick, and it's all pointing in a very positive direction. But then when do you turn these opportunities, or how do you turn these opportunities into trading opportunities? It's a bit different, isn't it? What are you looking at and why?
Thank you, Manisha. Some great points raised so far, and I'd say that just to give some perspective, if we look at what happened when the pandemic hit last year, there were asset classes that pretty much at the same time blew out, and the pattern that we tend to see from investors is that they'll tend to move into the Eurobond space first, where we had some very high yields across some markets, like Nigeria, where we saw dollar bonds reach the 14% level, which was in some ways unheard of. And so, because that market doesn't have the currency risk element, you would find that at those type of valuations, investors would move into that space very quickly, and would move into that space first. Going into the end of last year, the anticipation was that if the environment, the conducive environment towards emerging markets was to continue, that the local currency space would be the next to benefit from that, and that's actually what ended up transpiring. So just to put that in some perspective, this year in Africa, we've probably seen inflows from offshore investors in the tune of around $9 to $10 billion. And for 2019 and 2020 combined, that number is maybe down to $2 billion or so. So when the environment turns for our space, for frontier space, you do see some very meaningful moves into select markets, and that's really where the real opportunities lie. It's in those moments.
And can you run through some of those markets that you're thinking about?
Yeah, so this year, maybe some of the biggest beneficiaries have been Egypt and Ghana and Uganda, and to a certain extent Zambia and Kenya also. What's actually unfortunate is that one of the biggest ones in the pack, Nigeria, has been missing since the pandemic has occurred, and that's actually been a very topical point of conversation for many of us that cover Africa. Is that whilst we've seen this conducive environment for frontier, Nigeria has actually in many ways missed out on these inflows, and so it's what happens next is the real question.
Absolutely. And I want to come back to Brett, actually, because Brett, I know that we've spoken offline about where you're underweight and where you're overweight, and I'm just wondering whether the answer to that question is also reflected in what Shaz was just saying there.
Yes, absolutely. For at least for the Eurobond space, we, and going back to my earlier comments about the commodity cycle, we're overweight Angola, Nigeria. We also like Egypt and Cote d'Ivoire. Part of that is because we like the reforms going on in some of these countries. Angola, for example, It was punished early last year when oil prices collapsed, but they had been through a pretty ambitious reform program with the IMF, and it cut a lot of fat out of the spending, and so investors were willing to give them the benefit of doubt, and China was willing to give them the benefit of doubt and roll over some of these loans and help them get through this crisis that they experienced last year. And it's actually emerging from the crisis in even better shape because it's got lower debt service burden, and it's even leaner than it was in the past. And then as the oil prices have rebounded and are now in the mid 80s, it's got one of the highest sensitivity to oil prices, and so it just as it was punished on the way down, it is benefiting from that on the way up. In Cote d'Ivoire, similarly, we like the story there, but it's not related to the oil story, but we just like the reforms and the high growth that we get out of Ivory Coast and the generally good macroeconomic policies that we get out of there. Another turnaround story is Zambia. That's one where for even though it's currently in default, we just had a change of government in Zambia, and the new president is talking about embracing reform, talking about going back to the IMF to try and come to a deal and talk to Eurobond holders to get to restructure the Eurobonds there. So we think there's a lot of potential for countries that were already doing the right thing and are coming out of that pandemic in even better shape. And then there's some opportunities for turnaround stories. On the other hand, Nigeria, even though we're overweight the Eurobonds, as Shaz mentioned, we're completely out of the local fixed income market there. And we've been investing in Nigeria and local Nigeria off and on for many years before they were invited into the JP Morgan GBI, and even after they were kicked out, we've been involved in the space. But we've also been burned a couple of times trying to get out because of policy changes or regulatory changes that took us and many in the market by surprise. And so there's so even though that's not in the local currency index, it's one that we would completely avoid because we just don't know if or when we would ever be able to get our money out. I've talked with officials about how they might, when they're ready to have foreign investors back, about some ideas that they could use to reinsure investors and to get over that convertibility risk. But so far, even though we've seen some baby steps on the currency so far this year with getting rid of some of the multiple tiers of exchange rates, it always seems to be 2 steps forward, 1 step back. And I'm afraid as oil prices just continue to climb, it just gives them the opportunity to muddle through instead of taking the harsh reforms that need to take place so they can really move this economy forward.
Yeah. I'm really glad that actually you brought up the oil price. Razia, if you could just do a little bit of a scene set, actually, and we can talk about inflation. You got oil testing $100, and there are winners and there are losers from that, aren't there?
There are indeed, Manisha, and the really interesting part of this is that the winners and losers are not necessarily who we would always expect. Now, Brett spoke about the higher oil price and how this might be taking away from some of the momentum for reform in Nigeria. One of the very basic issues that the big African oil producers face, Nigeria and Angola alike, is that we are in a world where we are seeing more favorable prices, but there are question marks about whether they have the capacity to be able to ramp up production. Even as we've seen this favorable oil price trend emerging, Nigerian production seems still relatively contained at 1.4 million barrels per day. Nigeria very recently passed new oil sector legislation, We've been waiting this for long-time Nigeria observers. We've been waiting for this almost for over a decade. And finally, we see passage of this legislation aimed at improving fiscal terms, improving the clarity for potential investors in the oil sector. But in a still uncertain environment, we've got to gauge whether this is going to yield the desired results. Angola is another country that certainly benefits, of course, from higher oil prices. It's a major oil producer, but big question marks about the ability to increase production. Taking the flip side of your question, Manisha, and inflation, this is really interesting because we know the world over inflation has started to dominate investor conversations. Is this a transient inflation shock? It's looking a little bit more sticky. It's looking like it may be here to stay for a while. Everyone's watching services price inflation with some alarm. The really interesting feature of many sub-Saharan African markets right now is that, of course, given the weight of food and fuel in most headline inflation baskets, there's no getting away from the fact that inflation will be moving higher, but there are very few markets where we are seeing inflation that is considerably at odds with what we would have seen as the norm even pre-COVID. So there's something to be said for those markets with very credible central banks who have established their anti-inflation credentials, who will take action if they see signs of inflation, but core inflation in many of the very much more frequently traded frontier markets doesn't necessarily seem that much at odds with what we would have seen pre-COVID. And so I think there's something to be said for the policy response, policy credibility of central banks. Of course, one of the things that African economies could rely on during the COVID crisis, very limited fiscal room, no room for big, massive stimulus programs, but central banks were generally able to ease policy. The question now is whether we're going to see enough of an inflation shock for that easing cycle to turn around. And whilst we might expect some of the bigger, more established emerging markets, South Africa will certainly be impacted first, there will be a need to normalize reasonably soon. For a lot of the other frontier markets, it's not really that clear that there is this pressure, even now, for central banks to start raising interest rates. Now, that's something of a generalization. There are outliers, countries like Zambia, currency weakness, a recent crisis, and default on the external debt, where there might be a need to go faster. But the point I'm trying to make is that whilst everyone is super worried about inflation exceeding what they think of as the norm in more developed markets, in Africa, we're not really seeing anything that suggests, hey, this is really different from what investors have been used to. And in many instances, going back to those frontier markets that Brett and Shaz and Nick were all talking about, you are compensated as an investor by still sizable real yields in local currency markets.
Yeah, let's talk a little bit more. Thank you for that, Razia. We'll talk a little bit more about those frontier markets now. Nick, there are definitely some really good stories to tell there. We've already touched on a few of them, but if you had to hone it down to one or two, what stands out?
So for me, I think what will stand out is certainly countries that have embarked on a set of reforms and reforms that will be in the long term help the country to grow at a very fast pace. And top of my mind comes Benin. Benin is a small country in West Africa. They are part of the WAMU zone. It's a country that has been growing at 5 to 7% over the past 10 years. And the leaders of those countries know exactly where they're going. And I think Benin is a good example to give. You all remember all the discussion around the SSI at a point where the private creditors were asked to provide some debt relief to the countries in Africa. At that point, the finance minister of Benin went to the press and expressed very clearly that they were not interested in any debt relief. And I think it speaks a lot about the mentality of the country, how they are approaching their investment. And what Benin has been able to do is to access the market show that they are able to produce credible policies, and as a result, their spreads have compressed. And I'd like to give you guys just one anecdote. 3 years ago, I was part of a group of private creditors who were working with Benin to do a private placement for 3 to 5 years, and we were discussing at that point a yield of about 6.5%, and that was 3 years in euros. Fast forward 2.5 years after Benin came to the market, Benin was able to issue a 30-year bond at 6.5%. What it tells me is that whenever a country does the right thing, whenever the country embarks on the right set of measures, the market will reward that country with market access. And on the DSSI, and Benin is a very good example for that. And by DSSI, I mean the debt suspension initiative that was taken by the official creditors in March of 2020. Benin didn't need the private creditors to help them to pay their coupons. What happened was Benin was able to do a liability management. The country was able to refinance its short-dated debt and issue very long-dated debt at a better rate than what they were having in the front end. So this, to me, is an example of very good governance and a way to access the market in a positive way.
Definitely a great success story. But I do want to ask you as a really interesting question that we've had from one of our audience, Kamal in Boston, who's asking, for you, Nick, are private markets in EM a better expression than public markets to capture potential growth and avoid interim volatility? How important are private creditors in this investment picture then?
It's a very good question, and it's something that we have looked at a few times here. What I would say is whenever you do a private placement, you're doing a complete different investment. When you buy a Eurobond, you are subject to credit risk on one side, but you're also subject to market risk. When you're investing in a private placement or a loan, it's a buy to hold. So you're making a call on the credit worthiness of a country over 5 years. So of course, on one side, you don't get the volatility of the Eurobonds. But on the other side, you don't get the liquidity. So if your call or if your investment decision is wrong, then at that point, you can be hurt at maturity. What I would say, though, is that we've been looking at comparison of returns that you get on a private equity versus a private bond. And we've been in touch with people who've been running very, very successful private bond funds. And the return on the private bond is much, much better than the return on private equity, generally speaking. So a short answer to you is, yes, it's a very good way to invest in Africa.
Thanks very much for that, Nick. And it was a great question. I think I'd like to bounce to Shaz, actually, and get a little bit of a follow-up. I was just curious what you're thinking, having heard some of these responses. Because offline, we'd had a conversation about how the development in African markets has been so meaningful. You described it as that, and you mentioned that earlier in the conversation. How do you describe that word, meaningful? What are you talking about here?
So if we, the time frame that we look at, so I started looking at Africa maybe 15, 16 years ago or so, and at that stage, Nigeria had a fixed income market that had a 3-month and a 6-month instrument, and that was it. And so if we fast forward over time, the development that we've seen in that market and others is it's actually quite, it's a very nice thing to see. We have bond curves that go out beyond 30 years in many senses. We have local futures markets in some places, local forwards markets. So there has been a meaningful advancement of the local markets, which has allowed many of the sovereigns to increase their ability to finance in different ways than what they had before. And that's where the opportunities are created. And so when I look at, when we in the team here, we look at where is the next market that is likely to see a takeoff. Those are some of the factors that we plug and play into our, let's call it investment advice.
Yeah, and we were hearing there from Nick, weren't we, about success stories like Benin. What have been some of the success stories that have come up that you've taken note of, Shaz?
Well, the one that stands out the most for me is actually, I'd say, in terms of the smaller markets, is Uganda. It's one that I don't think I've had much pushback on from Africa experts. A central bank that has kept its market relatively open. Investors can get into and out of that market with very little difficulty. The barriers are not being put up there. And in some of the other African markets, it's trended the other way in some ways. And if I circle back to maybe a comment that Brett made, Egypt is one that stands out because of some of the factors that he was discussing, whereby it's been the repatriation method for offshore investors is a robust one. It's been tested. And so because of that, actually, we've seen inflows into that market again this year. So we have a lot of inflows into that market. And so those, if we take a big market, I'd say Egypt. If we take a smaller one, I'd say Uganda. They stand out in a very meaningful way. And I'm confident of their progress over the next year or so.
Thanks for that, Shaz. And I think also what you've painted there is a picture that offers many different opportunities, but we're talking about different points on a curve as well. I want to bring Brett in then to talk about that, because we've spoken offline about how you just can't judge Africa as this one homogenous region. We picked up on that at the beginning of the conversation. Let's talk about these different cycles that are running concurrently. How do you strategize? How do you navigate that?
It can be tricky. As we mentioned earlier, frontier investors are becoming more sophisticated, and differentiation among African countries is certainly increasing. Earlier, we discussed that commodity cycle. Some benefit from higher commodity prices. Some are actually hurt by them. Each of the 50 plus countries on the continent also have varied election cycles. So that's another cycle that we need to be aware of. Particularly for the agriculture producers, there are weather cycles that we need to be aware of. And then there are the reform cycles that, often these election cycles also tend to generate. And so from our perspective, we find the best opportunities tend to be around those inflection points in those various cycles. Sometimes things get so bad, whether it's governance, whether reforms have been so bad that it finally drives the country into the arms of the IMF, and then that's a great time to invest when they're about to embark on a multi-year reform program that will start bearing fruit with stronger growth and stronger returns on investment. And so from that perspective, you can get very good returns from investing at the bottom of that cycle. With commodities, commodities, again, you really have to dig down into those economies and find out what's actually driving that economy. Whether we've talked about Nigeria. Yes, it exports crude, but it imports a lot of refined fuel because they don't have enough refinery capacity, and they have to pay a lot of subsidies. And so for fuel prices, so they really don't benefit nearly as much from oil prices as they should. And so it's from our perspective, we really do just try and look for those inflection points, both on the way in, where it can give us an opportunity to capture the upside, but also sometimes those inflection points are at the top. You've got at any given time, you can have regime change that will, change the political dynamics in a country and the reform momentum in a country. It can either, those elections can either be a catalyst for reform, or it can be a drag or a reversal in reform. And so sometimes, those inflection points are a time to sell and lock in those gains to avoid future losses. I think, I mentioned Zambia's recent election is one case in point. Angola, a few years ago, was the exact same thing. We had avoided Angola for many years simply because we didn't like the political dynamics. But once President Lourenço came in, he immediately embarked on an anti-corruption campaign, He went to the IMF, and since then they've had a very robust reform program, and I think right now we're seeing the fruits of that, and so it's these kind of cycles that if you're aware of them, whether it's commodities, whether it's election, whether it's reform, whether it's weather cycle, you can really find an opportunity to invest across different points in the cycle, as long as you're looking for these inflection points.
Yeah, I guess you want to marry that opportunity with preparedness. However, as the last couple of years have taught us, you can still have something come out of left field that you have to deal with. On that note, Razia, let's pick up. One of the things we're also dealing with, it isn't just COVID that we are talking about a lot at the moment. Of course, we have to talk about a meaningful shift in terms of ESG. And we're talking about markets that are exposed, that are vulnerable to climate change. It is a global problem. It isn't just an African problem. But how are you seeing this conversation manifesting? Are you talking about it? And what are the concerns around it?
Absolutely. I think in the run-up to COP26, this is moving to front and center for many different countries, even those who had been somewhat slower in thinking about their climate adaptation and how to tie that into their financing needs. We already know about the macroeconomic impact of climate change. Take many East African economies, for example. For a long time, we used to see a severe climate event, a very significant drought taking place every 5 years or so, severe enough to have a macroeconomic impact. Now we seem to be seeing that taking place in an accelerated way. The urgency of taking action is increasingly clear to everyone. What hasn't been as clear, looking at the kind of assets that are originated, looking at the investment opportunities, is how this climate transition would be made more investable. I think that conversation has started in an important way. We haven't seen a great deal of green issuance out of Africa just yet, but if you were to ask what themes will become that much more important moving into 2022 and beyond, I think this is now front and center for everyone in terms of the risks, in terms of managing the risks, and also in terms of tapping into the pools of financing that might be available.
Yeah, can I pick up on this actually with Nick? Because I'm really curious whether or not that's coming up in your conversations and whether or not this institutional strength means that there's a robust infrastructure to see more finance coming in that direction towards ESG projects.
I think, thank you for the question. I think overall, a lot of the countries in Africa are moving towards more transparency. And as a result, I visited two countries in Africa that have finished their ESG framework, and they're looking to invest and go into that direction. But generally speaking, when it comes to transparency and accountability, I must say the continent has made a lot of progress. And unfortunately, the international press doesn't give enough credit to Africa for that. There are places now in Africa where you can see the detail of all the loans up to 100, as small as 100K. It's the case in Ghana, for instance. So all those progress have been made, and I think the ESG framework is just a natural development of the move towards more transparency.
Thanks very much for that, Nick. Shaz, I wanted to get a view from you because we are just minutes away from rounding up what has been such a vibrant and pacey conversation with so much excellent content and knowledge. I want to ask you, what are you wary of? You talk to clients every day. What are the concerns that they bring to you, and what do you tell them?
So I'd say right now the concerns that the investor base has in Africa are concerns shared amongst most of the investing community. And the theme is that if inflation is not transient and the Fed has to take actions above and beyond what's being priced into the markets, that would have a meaningful consequence in terms of some of those large sums of money that have flown in, perhaps turning out and needing an exit. And so I believe that right now we're in a phase whereby the next leg of the investment story will be determined by what happens with the inflation story in the U.S. over the next 3 to 6 months or so, Having said that, I do believe, if I go back to my favorite pick, I do believe that Uganda is one that will weather the storm relatively well, and it's definitely one of our favorite picks. But when we have, and not to go on too long, when we have moments whereby you get extreme scenarios occur outside of Africa, the correlation tends to go up in terms of African asset prices. So that's why right now it's I'd say we're at a critical juncture.
Okay. Well, I am also at a critical juncture because I'm a minute away from the end of our airtime. But thank you all so much. It's just enough time to thank you for all of those insights, and also our audience for sending in their questions. Some of them that we didn't get to included, what cryptocurrency will mean for Africa, what the digital revolution means for Africa. But hopefully there'll be more panels where we can discuss that a little bit deeper. But otherwise, thank you all so much for your contributions today. Razia, Shaz, Nick, thank you so much. Brett, for coming to the table to talk about this huge opportunity and the future for a beautiful continent. I'm Manisha Tank. Just enough time for me to say thanks for joining us and goodbye.